Well, I'm just going to go ahead and get started. Does that work for you?
It works.
All right. Welcome. Thanks for joining us. We appreciate it. My name is Rebecca Shepard, and I'm here with Peter Huckabo, and we are tax attorneys. So together, we've been practicing like 24 years or something. A long time. So before the pandemic, we would work with small businesses that were kind of on the bubble of viability, that we would work with any kind of tax dispute, whether there was a large liability, whether there was an audit, whether there were other compliance issues. We would help those businesses kind of get onto the path of compliance. Once COVID hit, we knew these businesses weren't going to be able to withstand anything because they're about to shut down for 6 weeks, 4 weeks. We didn't know how long. And so Peter and I dug down deep into the CARES Act and helped all these small businesses with, at first it was PPP. And at the time you couldn't use PPP and ERC together. And so we worked and got people, loans that were, later on forgiven to help them with payroll and rent in order to keep afloat. Then in December of 2020, Congress decided that you could use these two programs together. And that allowed us to help our clients get the employee retention credit, the ERC. And a lot of our clients were actually able to full pay their liabilities through this program, which was amazing. And they got money back. I had one of my clients tell me that, COVID was the best thing that happened to their business. She felt bad about that, but it really put them on a path to solvency. Once we realized how impressive and lucrative this credit was, Peter and I kind of started going on this informational campaign in order to help other people. And so we've been working with tons of small businesses and other industries to help get them the employee retention credit and keep their businesses intact. We'll kick it back over to Peter.
Got it. So, we're going to go through the basics and go into a little bit of details through this. But before we get into that, just a little bit of background, and Rebecca touched on it in her introduction, but there was a lot that was coming at business owners during the pandemic. So, PPP was out there. That was the thing that took all the air out of the room. And everybody was paying attention to PPP because it was worth $15,000 and change. And that certainly dwarfed what ERC was worth in the beginning, which was only, $5,000 per employee. And so, it was really only those folks who weren't eligible for PPP that were looking at ERC. Other things that were out there, Family First Coronavirus Response Act, FFCRA, that was, a program to help support folks who had COVID or were caring for close family members who had COVID. That was a credit available to employers. There was the ability to defer Social Security tax. For 2020, half was due December 31st, 2021, half was due December 31st, 2022. There was the employee retention credit, but again, nobody was really paying attention to that. There was Restaurant Revitalization Fund was big for, that industry. Shuttered Venue Operators Grant, SVOG. We'll talk about those later because they don't necessarily play nice with ERC in some circumstances. And then there was the big Economic Injury Disaster Loan, or EIDL, where the president basically said all of the United States is a disaster zone, and that opened up some loans from the Small Business Administration on some pretty favorable terms. So the universe of ERC legislation and sort of what started all of this was, the CARES Act. That was March 27, 2020. And what happened was December 27th, 2020, Congress completely flipped the switch and said, well, just kidding. You actually can get ERC even if you claimed PPP. We'll get into the nuance, related to that statement, but it's at least available. And then they said, well, not only is it available, but you can also get it for the first 2 quarters of 2021, not just 2020. And we're going to make it more lucrative and easier to get. Then, new Congress, new administration comes in. They do their own thing in the American Rescue Plan on March 11th of 2021. And they said, well, not only can you get it for 2020 and the first 2 quarters of 2021, now you can get it for quarters 3 and quarters 4. And then just to keep everybody on their toes, they changed it again on November 15th, 2021, mid-quarter, and said, hey, just kidding, guys. You actually can't do it for Q4 in most circumstances, and we'll talk through, those issues. This page basically represents everything we know about the credit beyond what's in the statute. And really notice 2021-20 is the big one that lays out a bunch of questions and answers that add some color to the statute. 2023, 4965 sort of track the additional legislation that came. So 2021-20 is the big one. These revenue procedures help us understand what to think about some of these other grant programs, especially PPP loan forgiveness. So this is the basis of our presentation today. Then before I pass it over to Rebecca, just payroll tax basics. We're going to get in and start talking about payroll taxes and tax returns and all that kind of stuff. That's just the vehicle that Congress chose to make this credit work. Don't get too bogged down in that aspect of it, but just generally, background is employers file forms 941 quarterly. They self-assess based on the wages paid, the employment taxes that they need to pay. And so that's the basis for how to claim this. That's just a choice that Congress made. Just keep that in mind as we keep going. You're muted.
Sorry, the host had muted all participants. Host, you can actually disable that feature. We're a small enough group that people can interrupt and ask questions. We're fine with that. So that's good news. Hooray. You guys can jump in and interrupt us. What are we talking about? What is the employee retention credit? Why is it important? Peter kind of gave you the background on it, but what is it? It's a refundable tax credit that eligible employers can get if they're eligible throughout COVID. So it's usually March 13th, 2020. An eligibility period can go through September 30th of 2021. And Peter will talk about some other examples as well. But it's a refundable credit. And what that means is it's not a carry forward NOL in 25 years, you're going to make $6,000. It is an actual check from the government for each 941 that is filed. So when Peter said it was claimed on the 941X, you're going to file one for each period of eligibility. You're going to get that many checks. So we have clients that get 6 different checks from the government per business owned if they're an eligible employer. So you'll hear me say this a few times throughout the presentation because it's really the most important part is that it's actually cash received by the business that you can use for whatever you want. So how do you get it? You go back. So there are different rules for 2020 and 2021. For 2020, the credit is 50% of up to $10,000 of qualified wages for the entire year. And then when Congress went in and said, okay, you can use ERC and PPP together, they also made it a much more lucrative credit. So instead of $5,000 per employee max, they said, okay, it's 70% of up to $10,000 in qualified wages per employee per quarter, adding an additional $21,000 per employee of possible cash received for the business. So the total you can get is $26,000. It's definitely a lucrative credit. So how do you get it? What is an eligible employer? An eligible employer is an employer which is carrying on a trade or business during the calendar quarter for which the credit is determined and either suffered a significant decline in gross receipts or a suspension of operations due to a governmental order. First, we're going to deal with a significant reduction in gross receipts. This is the easiest way to qualify. Peter and I tell everyone to do this first. It is the way that you just add and subtract and divide. There's no legal argument to be made here. So for 2020, if your gross receipts are less than 50% of the gross receipts for the same quarter in calendar year 2019, then you're going to be eligible. Now, again, when they expanded the credit, they also made it easier to get. So in 2021, instead of a 50% decline, all you need is a 20% decline compared to 2019. Now in 2021, there's also something called an alternative reference period, which allows for an automatic qualification for successive quarters. So what does that mean? For Q4 of 20, if your gross receipts drop 20%, then you're automatically qualified for Q1 of 2021, even if your revenue goes up 600%. It doesn't matter. This is not a test where you're making a determination of whether or not you need this money, whether or not the gross receipt decline is due to COVID. It can be for any reason whatsoever. We have a client who closed 3 locations in January of 2020, and they're eligible for the entire eligibility period because their gross receipts declined by so much. There isn't any other test other than whether or not the gross receipts declined. Now, what's considered a gross receipt and all that kind of stuff, sure, that can be a legal question. But once we know what the gross receipts are, the decline gives you eligibility. Now, what if your receipts did not decline by that much? What if your receipts went up? Is there another way to become an eligible employer? There is. That is if there is a full or partial suspension of your trade or business. The operation of your trade or business is fully or partially suspended during the calendar quarter due to orders from a governmental authority. So that is federal, state, and local government orders. Someone asked us about like foreign orders once. I just like to be sure that that's clear. Due to COVID-19. So the order has to be because of COVID-19 and it has to apply to your trade or business. Now it also has to say either a full or partial suspension of your operations. So go to the next slide. Just not sure. So it's a facts and circumstances test. So the first thing we're looking at is, did the government actually suspend part of your operation? So if you look at a restaurant was allowed to be open in Maryland, essential business, feed the community, but Governor Hogan said no in-person dining. You can be open for curbside, for delivery, for anything else, but you can't serve people indoors. The public health risk is too great. So part of that restaurant's business was completely suspended. There was no way to operate indoor dining. So what does that mean? As long as that indoor dining is more than a nominal portion of its revenue in 2019, which the IRS deems 10% or more, as long as it's more than 10% of the revenue in 2019, that business is going to be eligible as long as those suspensions are operating. Now, what happens when the dining room is open, but subject to 6-foot social distancing or subject to a capacity limitation? Now we're not looking at something that's completely suspended, but we're looking at a governmental order that's restricting operations, creating more than a nominal effect on the business's ability to provide goods and services. So when it's a nominal portion analysis, it's a lot easier, right? Open, closed, you're not looking at anything new. When you're looking at nominal effect, you now have to take into consideration drive-through sales, curbside sales. Did you start doing DoorDash and Grubhub and all these different ways to get people to eat your food? And now you're having people in your indoor dining. So now you can have a 50% capacity limitation. You can have 50 people in your dining room. What if you have a huge dining room and you never hit capacity? These are the kinds of questions that we ask. And this is really like where Peter and I spend 90% of our day, going back and forth about whether or not we believe that somebody satisfies the test of a full or partial suspension of operations due to a governmental restriction.
And Congress didn't help us in this stuff. The government has given us a safe harbor for this more than nominal effect stuff. And they've said, you have to be able to say that your ability to provide goods and services in the normal course was impacted by at least 10%. So it's still that same 10% test, not necessarily clear 10% of what, other than your ability to provide goods and services. What's the metric to track that? That's where this stuff gets really hard. And then we go back to, at its core, the government has said this is a facts and circumstances test. This is the area where this gets very, very difficult. Which brings me to my wet blanket slide.
Peter is the wet blanket.
For the longest time, government didn't really say much about this at all. And, we were seeing mills pop up and do this work. And we're talking to folks who, pre-pandemic weren't working in the tax space. They were, swinging hammers, right? But now they've identified that, they can try to do this work and that there's a lot of folks out there, wanting to investigate the employer retention credit, but they're doing it wrong and they're doing it poorly. And the taxpayer's not going to be served well at the end by having, received the credit, incorrectly. Finally, last October, the government came out and issued this warning saying, some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. We've seen some of these mills just take people through all 6 quarters and not do, PPP offset analyses and not work through the tough stuff with nominal effect. And, the numbers are just so big, the 50% multiplier, the 70% multiplier, there's a lot of junk out there. So just be careful. Improperly claiming ERC could result in taxpayers being required to repay the credit for sure, along with penalties and interest. They have, we are starting to see audits. Just whoever you work with, make sure you're slowing down and make sure they're showing you governmental orders. And we'll get into some of this stuff in the other slides, but showing you work papers, explaining to you what the theory of the case is, interviewing you and working with you to make sure that you're participating and choosing the start date and the end date for eligibility, if any, right? Not everybody's eligible for this. So to be a wet blanket, sorry. Thanks for listening. There is a third method.
This is my TED talk on being a wet blanket.
There is a third method of eligibility that was introduced later in the game called a recovery startup business. By definition, the business began operations after February 15th. So if you were in business pre-February 15th, 2020, this isn't for you, and you can disregard this method of eligibility. The additional definitional thing is that average gross receipts of the business were less than $1 million annually. Put a pin in that or keep that in mind when we talk through some issues related to controlled groups, because if you're in a controlled group with other businesses, you're going to have to consider their gross receipts as well. So you don't qualify under method 1 or method 2. So good point to bring up here is just keep in mind that these are quarterly tax returns. The theory of why you're eligible in one quarter may be gross receipts. In another quarter, it may be the governmental orders restricting commerce, travel, or group meetings. If you started after February 15th and you had less than $1 million annually, maybe you're a recovery startup business in quarter 3 or quarter 4. So that's the fourth bullet point is recovery startup business is only available to folks in quarter 3 and quarter 4. It is the only way to qualify for ERC in quarter 4 at all because of the Infrastructure Act. And it's capped at $50,000 per quarter, so total of $100,000. So just keep in mind, these are analyses that are happening in each quarter in each tax return. So the conversation so far has been eligible employer, and those are the three theories of how you can become eligible. But you could be an eligible employer and not have paid any qualified wages. I've certainly spoken to taxpayers who we get through that, startup and they say, well, my gross receipts are such and I qualify, or here's all these governmental orders and I qualify, and then you dig in and they didn't pay any qualified wages, either because of what we're about to talk about here, or strange family attribution rules, or some of the stuff that makes ERC hard in addition to that eligible employer analysis. So the first big thing to know is the definition of qualified wages generally for most taxpayers is going to be any wages that you paid during that eligible period. But it changes for large employers. And for credits related to 2020, a large employer is anyone who on average has more than 100 full-time employees. For 2021, it is any employer that has on average 500 employees, full-time employees. So the big thing here to remember is that this is an Affordable Care Act definition. It's grabbing Section 4980H, and which basically says it is on average 30 hours per week. The IRS has clarified and said, do 130 hours per month. And the reference period is 2019. So you are going through and you're not doing a full-time equivalent analysis, adding up part-timers. You're only looking in January 2019, who worked 130 hours. In February 2019, who worked 130 hours. And you're tallying all those up and dividing however many months you were open during 2019 to determine that. But again, just changes. It's a definitional thing that flips, if you had more than, well, I guess I didn't explain the change in the definition. So if you are a large employer, what it is doing is saying, well, qualified wages are only those wages paid to a worker who was not providing service to the business. So it's not a cliff. You could pay someone on the same paycheck to both provide service to the company and also not to provide service. So if you had only needed somebody for 15 hours, but you topped them off to 40, that 25 hours would still potentially be qualified wages. Back to Rebecca, who's definitely paying attention.
I am paying attention. This is not a cliff. I heard every word. Okay, so there's some limitations here. Obviously, the employees' wages, you're not going to go above $10,000. Things that we have not discussed yet, if you're a restaurant or a tavern or brewery, tips are counted. So this is money that's never touched your pocket that you're going to get a refund on, which is about as good as it gets, I think, as far as income goes. I can't think of a better way. Like Peter said, with the recovery startup business, it is $50,000 per quarter. That's a cap. Congress is rewarding you for starting a business during the worst time to ever start a business. So they're giving you kind of like a free up to $100,000, but there's no other qualification as long as you started it, after that February 15th date. Refunds of excess credit. I've said it once. I will say it again, and I'll probably say it one more time. This is a check from the government to you for each quarter of eligibility for each of your businesses. So we have people that own 6 restaurants, 6 different EINs. That could be 18 different tax returns, 18 different tax refunds. We're going to file them all on the same day. You're going to get them scattered because the IRS, but you're going to get 18 different checks. Here's the next slide. Okay, so Peter touched on this a little bit. You can't, when Congress changed the rules saying you can use these 2 programs together, there was a caveat that you can't use the same dollar twice as far as like PPP, and RRF is interesting because it actually kind of came into play after that rule came about. So for PPP, you can never use the same dollar twice. For RRF, you can for the first 2 quarters of 21. You can't for quarters 3 and quarter 4. If you're wondering what Peter and I have done the last 2 years, we've learned all kinds of Act 9 rules like this, whereas this is the rule as long as you're, April 1st through June 30th. But if you're July 1, then absolutely cannot double count. What we do as a firm, and I think this is really important to pay attention to and to make sure that if you're working with somebody who's not us, which is totally fine, that they give you something similar, is we provide a work paper that's going to say, Peter Huckabee, I paid you $40,000 this year. I have $20,000 of PPP forgiveness wages, and then I have $10,000 of ERC. You want to see exactly where the dollars go, because if you are audited in 2 years, 3 years, what happens is they're going to say, how'd you get to that number? And you're not going to have anything. You want to make sure you have a work paper. The other piece of this is that, you're filing this on a form 941X. It is a tax return. You're taking a position on a tax return that you're an eligible employer and this is the correct amount of the credit. Your tax return then gets processed. It's not like PPP where there's somebody who's actually reviewing your application, saying you're approved or not approved or rejected or whatever. This is something that's going to get processed and you're going to get a check. In 2 years, you could still get audited. A check does not mean that the IRS has blessed this return. In fact, the return has very little information on it. It doesn't say why you're an eligible employer. It doesn't say how many employees you're claiming the employee credit on. It doesn't say how many people are over the $10,000 of wages. It doesn't say theory of the case, any kind of substantiation. You're checking boxes and putting numbers down. Now, it's important to understand that because when you're making this position, when you are taking this assertion that you are eligible for this credit, you want to make sure you have some backup. And Peter's going to get into this, but I'm repeating it because we do think this is like the most important thing. And this is something we really are proud of in our practice is that, we will draft our theory of the case. We will put government orders behind it. We will put the work paper behind it. And then we're going to give you the 941s. So once you're engaged and everything is good, I'm obviously going to review your file for free, make a determination, send you an engagement letter. You'll then engage and we'll put all of this work into it. You're going to then review that, make sure you agree with us, make sure I didn't call you a dentist when you're a doctor, make sure I said you were restricted through March 9th. Maybe it's March 2nd, or maybe it's March 27th. There's government orders behind it. So make sure that you're agreeing to every single part of this case because you're signing the tax return. At the end of the day, you're agreeing to it, whether you review the stuff or not. So with other people, with other things that we've seen, because people have done it wrong and we've had to fix it and all of these other circumstances, what we've seen out there is a lot of the times the payroll company, it popped up out of nowhere, they're doing this work and they have a form saying we agree to these numbers that you sign along the 941s and nothing else. You want to make sure you're getting those government orders. You want to make sure you're getting those work papers. You want to make sure you're agreeing with the entire theory of the case before you sign that tax return. So that way you're all on the same page. So you claim it on the 940. In addition to all that, you're going to create this worksheet. The worksheet's terrible. But it doesn't even get filed with the return. So when I say very little is on that form, very little is on that form. This is something you need to keep for your records for each quarter of eligibility. So again, we have clients that have 3 businesses, 6 returns. That's 18 forms like this that are being kept for their records that they're going to be able to have to show if the IRS asks them, for an audit.
And just to put it in perspective, the first line on here is asking for qualified wages, which is a conclusion in and of itself. So much of this work is done, off any actual tax return, and you need to make sure that you have that data. All right, so the government actually has told us exactly what they're going to ask for in the case of an audit. And based on the audits that we've seen come through, that other outfits have shared with us, they are asking for exactly what they've said they're going to ask for. So, if you qualify based on a governmental order restricting commerce, travel, group meetings, they're going to ask for copies of those. And keep in mind that these orders, they were in place, they were amended, they were tweaked again, they were, wholly rescinded sometimes and then put back into place. Everybody said we were just going to do this for 2 weeks. So, make sure you get them all. And keep in mind that this stuff is starting to come down. In Maryland, we just had a gubernatorial election, and I guess when politicians get elected, they get new websites. So, a lot of the stuff's coming down. We use the Wayback Machine way more than we ever thought we would, in our practices. But even that is reliant on, this nonprofit that runs it to scan that corner of the internet on any particular day to make sure, we've got that archive. So important, and anybody that you're working with should be able to provide those so that you can review the language yourself. If you qualify based on a significant decline in gross receipts, you're gonna have to prove it. So generally that's quarterly P&Ls, but you're gonna want to have some level of confidence that your bookkeeper booked it in the right calendar quarter, because that's what's going to be important. So making sure you have access to those. Records of qualified wages, this actually may be the easiest. That's really just your payroll data. Large employers, evidence to show wages were paid when an employee was not providing service. Kind of hard, right? You're proving a negative, but I think if you have timesheets, you're going to want to, hold on to those, or your schedule, that you're sending out to the employees. Documentation of health plan expenses. These are the pre-tax dollars that an employer is paying to maintain health insurance on behalf of their employees. Generally, we see this used to top off a credit. So if someone's, up to $10,000 in qualified wages is getting throttled back because of a PPP offset or something like that, you may be able to come in with health plan expenses to get them back up to that maximum amount. Documentation of aggregate group employer determination. We'll talk about some of those issues on the next couple slides, but that's controlled groups of corporations. So, you need to know what other businesses are being owned by the folks that you own businesses with, and what is their spouse doing, and all this kind of stuff. So we'll talk through that. That's important. Copies of Form 7200. 7200 was actually an advance of the credit. It didn't work well. Congress thought that they would be able to pay the credit out even before an employer was required to file Form 941, and it just didn't happen. Copies of completed federal employment tax returns. Keep copies of the returns you file. Keep copies for at least 5 years, and we'll get into some of the next couple slides about why. All right, so this all sounds great. Everybody's getting all this money. There are some other things that make this really, really hard. In addition to that first one related to nominal effect. The first big one is controlled groups. So ownership aggregation rules may apply, and they impact eligible employer analysis differently. So, first of all, controlled groups. There's a parent subsidiary, wholly owned sub of another corporation. Well, there's also brother-sister controlled groups where, businesses are going to be treated as one employer because of the ownership structure. So brother-sister is a situation where there's both a controlling interest among the owners of multiple businesses and also effective control. And doing that analysis can be difficult, especially because family attribution rules apply, where one spouse, unless an exception applies, is going to be attributed the other spouse's ownership in that entity. Minor kids are going to be attributed their parents' ownership. So you could have a situation where husband and wife each own businesses that neither participate in the others, but they have a minor child under age 21, and that child is going to be considered the owner of both of those businesses. These are just the weird things that happen because this is overlaid on top of tax, the Internal Revenue Code. So you've got to be aware of these things. The other big catch is that majority owner. So greater than 50%, not 50-50, but greater than 50% owners, and deemed owners. So deemed owners are close family members, but it is capturing both in-law relationship and step relationships. So you've got to know who works in the business to make sure that you're not counting wages that are not qualified because they're considered deemed owners. Sole proprietor income is also not qualified, so that's different than PPP, where everybody was asking the sole proprietor filing on Schedule C, what's your net business income on line 31? That's not what this is. Sole proprietors can have wages, they can pay, or can have employees and they can pay wages, but it's a different situation. Household employers are not eligible. If you acquired a business during the pandemic, there's special rules about what to think about gross receipts from a time that you didn't actually own the business in 2019. So if you have that situation, slow down and make sure you're working through those issues. Statute of limitations So generally the statute of limitation is 3 years from the date of filing. So Rebecca talked about audit, right? This is triggering a new ASET, assessment statute expiration date. So from the date of filing this amended return, you're giving the government, in most circumstances, 3 years to come and audit your return. For quarters 3 and quarter 4, the government actually expanded it to 5 years. They gave themselves an additional 2 years. Now, they didn't expand the refund statute expiration date, RSED. That remains the same. So claims related to 2020 must be filed on or before April 15th, 2024. Claims related to 2021, add a year to April 15th, 2025. And then lastly, the big catch here, and really what's different than PPP, is the operation of rules similar to Code Section 280CA, which says if you receive a credit based on wages paid, you lose the deduction for those wages up to the amount of the credit. And what the government has said is they want you to go back and amend your 2020 or 2021, whichever return the credit is attributable to, the wages are attributable to, and reduce the wages claimed on that return up to the amount of the credit. So you, in effect, are going to pay tax on the credit. If you are a C Corp, the C Corp is going to pay, the tax, but if it is a pass-through, it is going to trickle down to the individual shareholders or partners, and they are also going to have to amend their Form 1040 and pay the tax. All that said, because of the numbers that we're talking about here, $5,000 per employee related to 2020, up to $21,000, per quarter total for eligibility in 2021 if you're eligible full time. The numbers are adding up and they're substantial. And so, it's still going to make sense to do this. I think that's the content.
Just one other thing about the tax part of it. People look at it as like a negative all the time because no one likes to pay taxes, and I get that. But I try to look at it as a positive. One, that's my pleasant disposition in general, but also because you're paying tax on it already, you can just take it as a distribution. This is your money now. Once you've paid tax on it, you're talking about something before, you don't have to pay it. Like PPP, it was like, okay, you've got to make sure you're using this much for wages, and do you have rent, and I have interest on a non-interest bearing loan, whatever. My Comcast bill is late, let me pay with that. This money, once you get it, you can use however you like. So it really is positive. And, we always say, somebody came in your building, your restaurant, and offered you like $15,000 for a hamburger, you'd still buy it. And you have costs associated and all this other stuff. You'd still buy it for you'd sell it for $15,000. It takes a lot for it to be too small to not be worth your time. And like I said, we scope it for free anyway. So if it's anyone's time that's wasted, it's probably ours. But we're around for any questions that you all have, either now or whenever. I always kind of close with the fact that, Peter and I have been doing this exclusively for better, for worse, for the last 3 years or so. We've had guidance dropped on us on a Friday night before Memorial Day weekend at 8 p.m. We have had long sessions on a Sunday night trying to get things together for a Monday because there was new guidance. We have spent more time on this than we have on probably anything else. And it's going to go away. It's a area of the law that is very up right now, but it is not going to last forever. And so we're like Def Leppard in 1987. This is the time to talk to us. We are happy to answer any calls. We do trainings for CPAs and tax professionals. We want people to do this right, even if they're our competition. We're fine with that. You're doing it yourself. If you have a quick question, we're happy to answer it. So please don't feel like you're wasting our time by reaching out. We truly don't mind and are happy to talk about something that we've spent so much time learning and perfecting and understanding that in 5 years, no one is going to care anymore about this stuff. So that's it. We're happy to be here to chat.
think there was a chat that came in.
I answered it.
Oh, okay. I'm just always afraid to click on anything while I'm running slides.
This is also me and Peter's like 137th webinar. So we've gotten quite used to how each other work. All right. Well, thanks so much for coming. We appreciate it. And we're ready.